back, I said we had some moves from Kerry that was going to start our block here. So you bought more, these are healthcare related, your wheelhouse. You bought more HealthEquity and you bought more Amgen. Tell us.
Yeah, so HealthEquity is in the health savings plan business. They had a cyber attack, not directly at them, but at one of their partners, and the stock came down as a result of that when they announced it at earnings. We had trimmed the stock twice, 20% lower than where it was. We think it's very attractive. We think the administration is inclined toward this business, and we believe there's a long runway for future growth. So that's HealthEquity. On Amgen, this is a stock that has been in the news because of Maritide, which is one of the GLP-1 and GLP agonist drugs. We really feel that it's got an attractive balance sheet. It's got a good profile of its pipeline. It has several cancer drugs. By Marituzumab, I know you like it when I say the whole name of the drug. That's a cancer, gastric cancer.
You have a very rare skill of being able to pronounce all of the names. I said it was your wheelhouse.
Thank you.
Some more.
It's a cheap stock, 14 times earnings, 3% yield. So, and Joe owns it also. So give Joe a plug for the Amgen.
Do you think that, I mean, do you have any confidence that the early year gains in healthcare, which was a standout,
right,
and it still is relative to many of the other sectors, can be sustainable in its own right?
Yeah, I think that they can. This is a group that has underperformed for 2 years now. These all sell at very attractive multiples. So if you're talking about valuation, they have valuation. They are coming out of what is the worst period of losing exclusivity on many of their drugs. And so you're starting to see pipeline phase 3 trials conclude, new drugs emerge in the market. And so this should carry them for the next several years.
They're also working off difficult comps as it relates to COVID, and they're beginning to grow their revenue once again. In the case of Amgen, you're talking about 8% revenue growth over the last 3 years. Look what they did over the last year, 24% revenue growth. So the revenue growth is coming back once again, and that's where you pay the premium.
What do you think?
I remember going to Fidelity talking to you about Amgen and Biogen and Genentech. Back in the late 90s, early 2000s. No? I love the biotechs. I love the biotechs. That's where we're overweight in healthcare. We're actually underweight healthcare because of the COVID overhang and the big pharma, but we love Gilead, Amgen, and United Healthcare.
What do you mean the COVID overhang?
The COVID overhang. COVID overhang of the big pharma stocks. Look at like Pfizer, Merck.
You hate the whole healthcare space because of two stocks?
No. Scott, you know Scott, you know the largest company in the S&P 500 healthcare sector? Lilly. Right. Lilly was the #1 performing stock last year. Why? Because of one particular drug. Period. So that's, you talk about the Magnificent Seven being concentrated. Lilly was concentrated, and people were concentrating their healthcare positions. We like biotech because of the cancer. We like devices like Medtronic, and we like the payers and the systems like United Healthcare.
Yeah, I think that makes sense. That's the right way to look at it? Yeah. Well, I think that Brian is talking about where is growth going to come, and that's more from the biotechs. I think that some of the big drug companies, not all of them, still have attractive valuation. They've de-risked, they have dividends, and they're selling extremely defensively, and so that's attractive in this kind of market.
You think, I mean, you better be watching rates then if you like the biotechs. Higher rates not good for biotech stocks.
Well, rates are probably going to go lower, number one. Number two, if you take a look at the dividend growth and balance sheet strength and free cash flow yields of Gilead, it's a monster. Yeah. And then their drug future, their pipeline is amazing. And so I think what happened in the 2 years that they underperformed is everybody went into Lilly, rushed into Lilly, and they sold their Gileads and their Amgens and their AbbVies, the names that we own, because of the pipeline, because of the growth, and because of the valuation.
And because of the fact that interest rates went up. The cost of capital increased dramatically for companies that have to spend.
The cost of capital goes up for those companies.
Wheelbarrows full of money.
But they don't
have to because they've got tons of cash on the balance sheet, and that's what they're using. They're not going out in the open market getting loans. It's
you're talking about the biggest of the big biotechs.
Correct.
Would you buy
that's the distinction.
Would I buy what?
Biogen?
No.
Well, it's still decelerating. Yeah.